Hey everybody, this is Jose Blasco. We are about to get started with the session. As always, as we begin, it's always good to have a quick sound check. So I know it's good to get started. Please go ahead and type a nice hello message on the chat box. That would tell me that you heard me say that, and therefore I know we're ready to get started. Always nice to start with a hello, so please do so. And we begin in just 20 seconds, everyone. Thank you so much. Almost there. 10 seconds to go, and we begin. Thank you. Perfect. That's it. Top of the hour. Time to get started. Welcome, everybody. This is our top trading session. My name is Jose Blasco. Today is July 17, 2022. And we are going to go over the platform top. Before we get started, I would like to highlight the financial disclaimer that we have on the upper left side of the screen. Please read it carefully since it is important information. I am counting on you guys to read it completely, as I always say, because it's indeed important. It's fairly short, so please do so. Do not skip it. Thank you so much. Joe, how are you? Good to see you. Very nice to see everyone. And again, for the ones of you that may be new to the top session, so what we do here is we look at the platform top, the Tradictive Options Planner, but we also combine often lectures on trading, because in order to understand the use of the platform, the software, and so on, often we cannot detach it from talking about trading, and therefore these sessions often, I would say, are quite interesting. Okay, so hopefully you will have fun. You will learn a lot. Hopefully you will have questions from me as well. Feel free to be interactive if you are attending live. The chat box is there for that, so go for it. Okay, very good. Fantastic. Jeff, how are you? It's good to see you, my friend. Very nice. Okay, so let's begin. I'm just gonna close this introduction slide. The session is now officially introduced. This is top. This is the platform that we're talking about, and this is what we begin. Okay, so we've been conducting a collection of top sessions in the past, where little by little we go from feature to possibility to opportunity. And today the plan, the last time we talked about the option chain, for sure we can talk about the spread select window, we can talk about the strategy builder, which we already did in a past session. But for the spread select, since it's a pretty advanced tool, I'll keep it, for a little later. And today I was planning to talk about the risk graph. And depending on how fast we go through these materials, then we may add a bit more. Okay, but the protagonist for today's session, it's going to be the risk graph. Okay, this is the one tool that we're gonna start discussing to put those trades together in place. Okay, Mark, it's very good to see you as well. It's good to see you all. So let's begin. Okay, so the risk graph. Let me float it and maximize it so it takes the whole real estate or the whole space on the screen. The risk graph is the protagonist, as I said today. So the other functions of the platform, for now, we're gonna put them on the side. And so what is the risk graph? Well, if you're an options trader, obviously you've seen this before, isn't it? Different platforms will have a tool of this sort. They may look slightly different, but in the end, the purpose of these tools is to show you a vertical axis with the profit and loss of the trade, where above the zero line you are profitable, and below the zero line you are not. You're losing money. Your trades will lose money. Apart from this vertical line with the P&L, we also have a horizontal line, the zero line I just mentioned ago, that comes with the horizontal axis that represents the price of the stock. Okay, so in this case, we're looking at the SPY ETF. As you can see, the last traded price is 385. This is also identified with the white dotted line, typically close or very well centered, close to the center or very well centered in this risk graph. You can see as well the current price, 385.13, which coincides exactly with 385.13 up there on the top left. Okay, so as I was saying, the risk graph has a purpose, which is to tell you if your option strategy is profitable above the zero line, or if your option strategy is losing money below the zero line. out of what the price of the stock doing, which is basically the horizontal axis. So in other words, to understand the market going up, the stock going up, you would want to look to the right side of the graph. To understand what happens when the market goes down, you will want to look at the left side of the graph, always using the midpoint here, the vertical dotted line in the middle, which represents the current price. So towards the right, using the current price as a reference, the stock goes higher. Towards the left, using the stock price as a reference, the stock goes lower. And as you see the price go up and down out of this reference price, then you can see how we end up being above the zero line and therefore profitable. And you can see here it's highlighted in grid, so green shaded, right? Or you are below the zero line and therefore you are in the area which is shaded in red, okay, below the zero line in this particular case, okay? So this is the purpose of a risk graph, and if you have never seen a risk graph, so again, there is so much more we can say about a risk graph. At the same time, I want to assume to a certain degree that you know what's a risk graph, so I can get into the functionality of it. But again, for the ones of you that never seen it, so that's what a risk graph is designed to do. Basically, tells you what's going to happen to your trade, what's going to happen to your P&L if the stock goes up or down, given the option strategy that you are currently using. Of course, there are many what-if scenarios, which is the reason for all those sliders in the bottom part, right? Where now you can change certain conditions and reassess what the P&L of the trade would be, again, using this format. Again, going to the right when the stock goes higher, going to the left when the stock goes lower, above the zero line being profitable, below the zero line being in a losing trade, okay? Something that confuses me a lot, but it's a beautiful functionality in the platform, is when you come to the bottom right here, where you have this show chart button, where when you click, instead of looking at the risk graph horizontally, the way I just explained, which is how it's presented in, I would say, 99.9% of the options platforms that exist in the world, well, when you click on that, what becomes the protagonist is not the risk graph, is the chart. And notice how the risk graph changes with a 90-degree rotation, and it becomes now vertical instead of horizontal. So again, in my case, given the fact that I am used to use risk graphs for many, many years, looking at the risk graph vertically kind of confuses me. Having said that, for the majority of new options traders, it's actually the opposite. The risk graph tends to be a tool that is seen as abstract and confusing, where when you go ahead and you put it vertically, now it makes a lot of sense, right? Because if the stock goes higher, okay, so what happens when the stock goes higher? Where your P&L goes higher, right? When the stock goes lower, so what happens to your P&L? Well, then your P&L, goes lower too. And that's why you get in the red when it goes lower. That's why you get in the green when it goes higher. So again, it's another way on how to look at the risk graph. Most of my demonstration today would have me use the classical horizontal version of the risk graph, but know that you have a possibility to do that. Okay. Joe, I'm going to be discussing the ideal strike zone in a moment. It's indeed something very powerful, very interesting, and we're going to be talking about it. Okay, so thank you for that question. I'm coming to you in just a moment. Okay, very good one. So anyway, so that's a risk graph. Okay, now in a classical way, you would come into the upper part of the risk graph, where there is a section here that by default it comes with a long call. Okay, and you would just come in here, and instead of using a long call, maybe you decide you wanted to build a bull put spread, for example. So you would just select that from the list. And now you have, as you can see, you buy an option, you sell an option. There are two puts. It's a bull put spread. Of course, the risk graph automatically changes. But of course, that risk graph changes based on what you added, what you add to it. And therefore, the edit spread button is critical to either edit the bull put spread. In this case, I have selected maybe to change the strikes. Maybe you are going to be buying the 382, for example, or anything different. Maybe you use a different expiration date, whatever it is. You can select the drop-down menus to change all of those parameters. And when you click OK, of course, your risk graph would be recalculated given the new selections of options that you have done. Um, of course, apart from selecting from the drop-down menu bull put spread, which by the way, it's also inside this pop-up window. When you click edit spread, you have the same menu here with all the strategies. You can certainly also go ahead and delete everything. Everything is now empty, and now you can start building things by manually adding options legs or manually adding a stock leg as well. So you can be like, okay, I want to build a butterfly, which is made of 4 units. So maybe you would add 1, 2, 3, 4. You know it's 4 units. Okay, and now let's say you want to start buying the 385 call, and then you want to sell 2 of the 390 call, so 390 and 390, and then you want to buy the 395. In this case, it's all calls, as you can see on the call column. So you could certainly adjust this manually as I just did, and when you click OK, so here's your butterfly with a classical triangle shape on the risk graph. Of course, you may be thinking, wait a minute, why did you have 2 rows for this 390 call? Maybe you could just have sell 2, which is the quantity column, remove this one with the red X. As you can see, I can remove legs. So you buy 1, you sell 2, and you buy 1. And if I click OK, I'm going to get exactly the same risk graph because it's exactly the same thing. So again, you could add here multiple legs. You can keep them separate. You can change the units. They don't need to belong to the same expiration date. Maybe the one you are buying there is July 20 instead of July 18. Maybe instead of a call is a put. So you can do anything you'd like. Of course, if you do a non-common combination, instead of giving you the name of the strategy here on the upper left, which in this case is a long butterfly. So if I use a non-standard expiration date with a combination calls and puts, that's non-standard. So if I click OK, now this is going to show, it's going to give you the risk graph, but it's going to give you the unknown message, meaning that there is not a name for this particular option strategy, even though it could certainly be a very nice idea to trade it if you've done your analysis, backtesting, and you know what you're doing. But it's not a classical option strategy which is kind of recognized by the industry and therefore has a name, such as a bull call spread, an iron condor, etc., etc. Okay. So you can do anything you'd like here. You could add more legs. There is a limit, which is 8. So if I keep adding legs, notice that there is a moment in time where it grays out. So if you do the count, it's 8. So if I click OK, the whole thing is going to be plotted here for me, the net result. But obviously, if I wanted to add more, then I cannot, because that's the limit. The one thing you can also do if I edit spread is to add stock legs. So combine with all those options contracts, I could add a stock leg where I could be either long or short shares, and maybe you're short 50 shares. So this is how you would represent it: short 50 shares, and now click OK, and now you are combining short 50 shares combined with all those 8 different legs to create this particular risk profile, which seems to be bearish, meaning that if the stock would fall, then you would get into the profit zone. If the stock would rally, then you would start losing. Okay, which is what seems to be happening here with this particular trade. Okay, that's the beauty of the risk profile. It gives you a good understanding of what is going to happen to your trade if the stock goes up or down, as well as if time passes, its volatility changes. Again, we got the sliders in the bottom part, which I am going to discuss in a moment. Okay, very good. Now, let me delete all of that. Okay, and here we go. So if I add nothing, obviously everything is going to be blank. Okay, so now let's rewind a little bit and let me give you more deeper understanding and view of this tool by actually building a trade. Okay, and I want to start from simple and then add more elements to this conversation. So I'm going to build a bullish trade made of buying a long call, such a simple strategy, right? So I'm going to buy a long call, and the moment I buy a long call, I got the classical risk graph of a long call, which is limited risk, unlimited reward. So the more it goes, the more you make. The more it drops, well, you lose, but the most you can lose is what you paid for the option. Okay, so that's great. So that's that very specific comment I just made, which is to know how much you make when you make, and how much is the maximum you can make, and how much you lose when you lose, and what's the worst case scenario. This is what is being presented to us on the right as max risk and max profits. Notice that the max risk of the trade is $1,101. Okay, which in this case, you buy a call, the most you can lose is what you pay for it. And since this call seems to be priced at 1101, so obviously the max risk is 1101. That's an easy one. And the max profits is infinity. Why? Because if the stock was to go to the infinite, you would make infinite because it's a long call. So there's nothing from stopping you from making more. Okay. Again, those are statistical and theoretical values. Of course, you probably as a trader have a target, so when you get out you will have a limited profit, not an unlimited infinity type of profit. But again, the math is what we have on the screen, which is, worst case is lose 1,101, best case is to make infinity. Okay, so again, this is very clearly seen on the risk graph. When utilizing the tool, you can also drag the axis like you would do on a chart. So if I go to the horizontal axis and I notice how my mouse changes from the classical cursor to this double arrow that goes horizontally. So if I click, I hold on my mouse and I compress. So notice how the chart is compressed by a lot. Okay, and now I can see how the profit goes to the infinity, and worst case, the most I can lose is limited. Okay, you can see that by having this horizontal line. No matter you go down, no matter if the S&P drops all the way to 50, knowing that the current price of the S&P, okay, is 385. I should say the S&P ETF. Even if the S&P drops to 50, the most you can lose is the same 1101. Okay, we can see that very clearly on the risk graph. Of course, when you do this, now if you want to go back to where you were, you can obviously also work on the horizontal scale. But just like on the charts, we have very useful buttons here on the bottom right, which is the reset button, which is gonna get you back to where we were, and also you have the zoom in, okay, and zoom out button, which basically do the same thing that you will achieve by acting on the horizontal axis like I did before, but another way to do it, which maybe it's more convenient to you depending on preferences, okay, on user preferences. Okay, so now that we know this, I'd like to look a little deeper into what we have inside the risk graph window. And the first thing I would like to point out is the fact that on the left and the right, we got two vertical lines which are a purple color. Those vertical lines represent one standard deviation of price movement to the downside, as well as one standard deviation of price movement to the upside. And that projection of price movement using a one standard deviation is done using two important parameters. Number one, the expiration date. In this case is August 19. So what happens if I use a different expiration date, like a shorter one? But if I use a shorter expiration date, you will see how those lines are going to get closer to each other. Okay. It didn't look like that visually because the chart rescales. Okay. But if I was to go back to kind of like where I was before, so now those lines will be closer to each other. Okay. Because again, the chart rescales. The second thing that is being used in the calculation for those vertical lines with the purple color is historic or historical volatility. So basically, this price projection, this what do we expect from a move to the downside in one standard deviation of the cases, which is 68.2 something percent of the cases, to the downside and to the upside, that expectation is based on the historical volatility of the stock, meaning that if the stock continues moving at the same speed at which the stock is currently moving or has been in the recent times currently moving, that's historical volatility. So based on that price behavior, you would expect price to be where the purple lines are in that expiration date in one standard deviation cases, okay? Meaning 68.2% of the cases. That's useful, especially when you are looking at setting a target. So let's say you are setting a target and your target is located all the way at 425, but here it tells you that one standard deviation of the cases is that we're going to reach this point, meaning that reaching 425 is probably quite unlikely because it looks like to be kind of like double the move. That is two standard deviations, and I guess we know that a two standard deviation move is something that is not that likely going to happen, okay, or is less likely, much less likely going to happen versus a one standard deviation of the move. So again, to make sure that your targets are fairly easy when it comes to being hit. A good practice could be that your targets are always in the inside zone between the purple lines instead of in the outside zone beyond the purple lines, because you may not get there, even though maybe a very good target, you may need more time. And again, one way to fix it could be just to increase the dates. Maybe you go for October, and now instead of a little less than 405, so now the purple line is pointing at 450. So now if your target is 425, now you got plenty of time to get to your target. Okay. Again, we have other tools in the platform, such as the strategy builder, that calculates what we call the time to target, and therefore you can be very precise about that. But again, maybe you have a methodology on how you trade options where by default you always use options that expires around 60 days, around 45 days, around 90 days, around 20 days, whatever your methodology is. Well, if you have a methodology which is static when it comes to your expiration date, a good use of the risk graph, apart from understanding the trade behavior, could also be to understand what's likely from a price movement point of view. No need to say that inside Top we have other tools to do that. I just mentioned one, the strategy builder. Another one could be the probability cone, right? That tells where the market should be in a specific date, in the future. So again, we got other tools, but for the ones of you working on the risk graph as your main planning tool, so this could be a very efficient way to understand where is price going or where is price not going. Talking about where is price not going, another use for those vertical lines could be to do non-directional trading and betting that the market will remain range bound. And in that sense, you would want to basically, let's say you are doing an Aron Condor, so you are an option seller and you want your options to expire worthless. So then selling options above the purple line and selling options below the purple line instead of within the purple lines, that would increase your probability of those options to expire worthless. Of course, doing it just because of the purple line, in my view, would be a bit too simplistic and a bit too naive. There are many other forces in the market, so as you probably know, if you have been watching my live sessions, of course, I will not do that without looking at the UFOs. And if I have UFOs on the chart that reinforce the fact that these purple lines are going to be respected, because you may have UFOs above and below. You know what? In this case, I'm going to turn the risk graph this way. So, for example, let's say you have UFOs above 455, and the purple line says that it's not likely for us to go above 455, and you have UFOs. So what may happen is that the price goes up, tries to go above 455, hits the UFOs. Okay, that may be somewhere here on the screen. And now as price hits the UFOs, it comes back inside your zone within the purple lines. So great, now your non-directional trades are working well. So again, if you combine these purple lines calculations with a proper technical analysis of your charts, in this case, my suggestion or preference would be the UFOs. So you're making your trades stronger from a statistical point of view instead of just relying on a mathematical calculation, which is very useful and certainly very smart, but it's just math. Okay, it's not on-field orders. Okay. So anyway, long chat about the purple lines, very simple, but also very useful and can be used in different manners. Okay. Joe was asking about the ideal strike zone feature, which I'm going to discuss, but also you are discussing the target date, which is very related to what I just said. So maybe I will talk about this first. Okay. So again, if we look at SPY, for example, and you were to point at, let's say 400.74 as a target, and you right click and you send 474 to the strategy builder, so you're going to get a target date estimation of August 5. Okay, you're gonna get that. So your question is how accurate that calculation is, and the answer to that is it's it's very accurate, but with the uncertainty of not knowing the future for sure. Therefore, it's always good to give an extra wiggle room to that date. Notice how the trades that are being built with the strategy builder are using August 19, where the expected date would be August 5. Well, we are still giving extra days, okay, all the way to August 19. Why? Because, I mean, it's no way you know for sure. If you recall, when we talked about the strategy builder, I believe I did explain that the way these dates are calculated is related to what the probability cone does, which is doing price projection. Okay, but also this calculation is weighted and combined with regression lines. Okay, which you know, if I was to project a regression line like that, it will look something like this. So notice that the regression line may suggest reaching certain targets sooner uh, um, than what the probability cone suggests. So there is a moment in time in the beginning stages of the trade where the regression line is taking a bit more priority, and later in the life of the trade, where the probability cone is taking a bit more priority in our calculation. It's a pretty complex calculation, and I would, if I can, I would say it's a pretty smart and definitely quite accurate calculation. But at the same time, you cannot predict the future, and especially in the world of stocks, we know stocks heavily depend on things such as the sector in which they are, other stocks that maybe they're competitor stocks, and things of that sort. And therefore, a stock is supposed to move at a certain speed, and next thing you know, something is happening with a stock that belongs to the competition, which is now affecting that stock, and therefore that stock is not at all behaving the way it was expected. That's why we always give extra time to the trades. So again, I believe that the calculation in the strategy builder is, let's say, a more elegant way on how to put the trade together. But again, what I'm discussing here now with the vertical lines, it's more the process for a trader where, let's say, you have a methodology on how to build, let's say, option spreads, where the way you do it is you come in here, you do, okay, I'm going to do a bull call. So here's my bull call. Okay, but now how do I trade? Where the way I trade, let's say, is I use 60-day expiration options. So you come to an option chain and you look at that and you're like, okay, so September 16 is 61 days from now. So that's the expiration date I'm going to use. Why? Because it's around 60 days. And maybe your rule is I'm using 60-day options. Nothing wrong with that. I mean, in my mind, it could be done differently and could be more optimal, but this is certainly a way many traders trade options, and there is nothing wrong with that. Okay. So let's say you come here and you're like, okay, so I'm just going to use September 16 because it's around 60 days. The moment you do that, here we go, you got your calculation with the vertical lines. And now let's say your target was 460, you will be like, well, you know what? I guess my target is too far. I better take profits sooner, right? Because my target implies that price needs to move at a pace which is going to surpass what one standard deviation of price movement is. So I need to be quite lucky, just to use a imprecise, but you get what I mean word, to get to 460 before that option expire. Okay, so hopefully this makes sense, and it gives you another way on how to use the risk graph, especially if you are that type of trader. If not, again, on the charts, we have tools that are more precise to understand price ranges compared to those vertical lines, which are there for a reason. They're very useful, but again, especially when you approach putting your trades in that type of process. Okay. When it comes to your cover calls, Joe, I would say we are getting into a different type of conversation here because, again, I'll just give you a little hint here, but we will need to address that in a different session to not to divert that much because that's a conversation on itself. But basically, what you will want to do really, of course, is to anticipate where price may be in that future date where you want to do a cover call, but also maybe in order to decide what date, you may want to look at the skews, and maybe you want to look at the calls, and maybe you look at different expiration dates. Okay, and maybe maybe you are there is a red UFO at 390, so you want to do a cover call at 390. So the question is, which one pays me the best? So you would want to pick the expiration date with the greatest implied volatility. Again, there are multiple other tools that you can use to um, try to avoid being called away if that's what you're trying to do, but also try to get as much premium as possible without being called away. And of course, the risk graph here is way too simplistic, as well as using a target date with a strategy builder is also too simplistic too, because the way the target date is calculated on the strategy builder is a date where you plan to be there at that time. Okay, and with an extra wiggle room, which implies the use of extra time, meaning that date is calculated assuming the stock is going to move there efficiently. Where when you do a cover call, I am guessing you want to do the opposite. Okay, I'm guessing that you want to do the opposite. You don't want to be called away. So again, that calculation, it's probably a bit too optimistic for that kind of application, and I would approach it in a different way. And again, we could certainly have a session to talk about that in the future, and maybe I can give a couple of additional ideas for you to backtest and see if they work better compared to your plan. But having said that, let me say one last thing about the cover calls, because this is kind of like the natural, frustration, if I can use this word, that I've seen all the time amongst cover call traders, which is they are doing cover calls trying to not to be called away. And the only way to do that successfully, meaning defining success by not being called away, the only way to do that consistently without being called away is to sell calls very far away, meaning that you can get paid extremely little. And most of cover call traders don't want to get paid that little, so they end up selling calls closer and then they get called away, but then they don't like it. So again, there is no magic formula for that, really. Okay, but again, we can talk about equivalencies. We can talk about acting on cover calls before you get called away, to get put back in case you get called away. Again, we can talk about some sort of conversions and things of that sort in future sessions. Happy to do that. But again, that would deviate me too much from today's topic. Okay, but again, a little bit of food for thought, Joe. Hopefully, I'm getting you thinking, which I'm sure you are. Anyway, going back to the risk graph. Okay, so let me go back to where I was, which was a basic long call, and I'll take a sip of water if you don't mind. So thank you for that. So what do we have here? Again, long call graph, simple one. I guess we have all seen that one. And the one thing I would like to highlight now is that little rectangle, which is what we call the ideal strike zone. And you can see it's showing up because over there we got that check mark ticked. Okay, it's ticked. If I uncheck it, notice that rectangle goes away. Same with the puts. If I highlight it, now we have a rectangle, a red colored rectangle, which is the put one, which if I uncheck, it goes away. And if I check mark both, then both show up. Okay, so what those rectangles represent, what are they there for? How can we use them? Is it useful to use them? Let's talk about this. First thing I will say is that I believe those two guys are such an innovative way to think about strike selection when trading options. No matter if it's going to be a call or a put, or it's going to be a spread or some sort of a complex combination, those rectangles are very, very, very powerful. Why is that? Well, first, let me tell you that all options pricing models, and the pricing model that we have in our platform too, they all assume a standard distribution of data. Okay, or in this case, data is price, so standard division of price. What does that mean? It means that no matter if you apply Black-Scholes model, no matter if you apply whatever model in top, you probably recall that I said in the past we use binomial, which is probably the most advanced pricing model. Doesn't matter if it's advanced or not, we are also assuming a normal distribution of price. What does that mean? The expectation, the assumption is that anything could happen anytime. So tomorrow the S&P opens, it goes up, Tomorrow the S&P opens, it goes down. Tomorrow it opens, it goes up a little, or downs a little, it goes up a lot, or it goes down a lot. Anything could happen anytime, which I think is a very fair assumption, because truly the market could be quite random, and therefore anything could happen anytime, and therefore having a pricing model that uses that as an assumption, as a base, makes a lot of sense, right? And therefore all the analytics are calculated out of that, and it makes a lot of sense. But the reality is that that may make certain calculations a bit too optimistic. And why is that? Well, the reason why is because the reality is that not everything has the same probability. For example, while anything could happen anytime, let's say the market is in an uptrend. Well, if the market is in an uptrend, actually you have a higher degree of probability for the market to move higher than to move lower. That's why it's in an uptrend. So while anything could happen anytime and tomorrow the market may be down, there is a little bit of an extra chance for the market to go up instead of down. So there is a skew. There is the normal distribution of price that, if you allow me to do a little bit of unprecise drawing on the screen. So a normal distribution of price is often represented by a graph that look a little bit like that. Okay, I guess you've all seen it, and I'm apologizing in advance for the lack of precision in my drawing, but this is a bell curve where the majority of the things that happen here in the middle. That is our 2 standard deviation. Okay, one standard deviation, and whatever is outside on the right or the left is less likely to happen. That's our 2 standard, 3 standard deviation. But that distribution, putting on the side my terrible drawing, is well centered and symmetrical. Where the reality is that, let's say you have a situation where there is a bias towards certain direction. So maybe the way on how this should be looked or drawn, instead of an exact bell curve that comes to the midpoint, and then the part on the right is extremely symmetrical, exactly symmetrical to the left. Again, I apologize for my drawing one more time, but let's pretend this is exactly symmetrical. Well, now what you may have in the real world is that maybe there is more probability for something to happen on the right side, and therefore it goes like that, and it's a totally different distribution. Meaning that you have even in weird cases, you are still in more centered, if you wish, in that particular shape I just drawn on the screen. And again, I will apologize one last time for how terrible my drawing was. Just a bit of humor here. So anyway, but you get my point, right? So now, what's the issue with that is that when we throw there calculations where we are anticipating situations where options are in the money or out of the money. And I'm going to bring you back to the option chain, where we have, for example, here the probability of an option to be in the money on expiration. Okay, which is a very interesting calculation, which I use it all the time, by the way, when I build iron condors, for example, using the spread select, okay, with the filters. Again, if you don't know what that is, we'll cover that in a future session. But these calculations are very useful. But the problem of these calculations is that they assume a normal distribution. So if everything is possible, you got 49% probability for the 385 call to be in the money on expiration. Okay, and of course, the deeper in the money it is, the higher probability it has to stay in the money. The further out of the money it is, the less the probability that it will be in the money on expiration. And those numbers are basically the options pricing model in action, assuming a normal distribution of price. So again, very smart calculation, but very optimistic too, because the question is, what if price does not have a normal distribution? Well, guess what? Here's where a very famous Russian mathematician, I'm not sure I will pronounce the name correctly, his name is Chebyshev. So this Russian mathematician came up with a theorem that allows to do certain statistical calculations, for which his formulation applies to all distributions. No matter if it's a skewed distribution, up, down, in the middle, whatever, or a normal distribution, the formulation is the same. So this is exactly what is going on when we tick call ideal strike zone or put ideal strike zone. We end up with this particular box, which is now showing us around the zero line. Okay, notice this is very important. Notice that this is plotted around the zero line. So it's giving you basically 3 price points. In this case, it's more or less 405, more or less 401, and more or less 392, something like that. So you got these 3 price points, okay, all around the zero line. So what is this trying to represent for us? Okay, and going back to the option chain, the probability I was discussing here is the probability of the option to be in the money on expiration. What we are plotting on the risk graph, thanks to the ideal strike price and the Chebyshev theorem, it's not the in the money probability, it's the break-even probability. That's why we are plotting it around the zero line. So what does that mean, break-even probability? Well, think about it. This option got 49% probability of expiring in the money. But for you to be into this option, you had to pay X amount of money. So given the amount of money you pay, right, you need that stock to be in the money by a certain amount for at least to you to break even. So it's not enough to be in the money to make money. You need to be the stock to be in the money plus a certain amount, which is the money paid to get into this call. So you are now break even. So the probability of break even, okay, it's a very interesting calculation, but again, in the option chain is based on a normal distribution of price, where here, plotted in a graphical manner instead of percentages, we have this horizontal rectangle that is telling you that you have a fair chance of breaking even. Okay, why breaking even? Because this is this diagonal line that I'm drawing here in blue color. This represents the P&L of the call on expiration. Okay, so this is the much you can lose, and the line that goes up with an angle, it's how much you can make. The dotted line here, I haven't said it, I haven't talked about this yet. That dotted line represents the real-time P&L now. Okay, so we are not talking about the real-time P&L now. We are talking about the P&L on expiration, crossing the zero line. That means breaking even on expiration, right? So if you use the 385 call, you are in the shaded area of this rectangle, which is between 392 and 401. Let's call it 401. So you have a very high chance, based on the pricing models plus the application of the Chebyshev theorem, which is more pessimistic than a normal distribution. So you have a fair chance for that option to break even or better on expiration. In other words, selecting the 385 call, it's a pretty good bet from the point of view of statistics, thanks to Mr. Chebyshev. It's not me saying it, it's Mr. Chebyshev. And in this case, it means that even if a stock is not doing what you want it to do at the speed you want it to do it, you have a good chance, statistically speaking, that on expiration, at least, you'll be breaking even. Now, of course, to do this trade, in this particular example, with August 19, with the S&P ETF, you will need to pay $1,101. So you have a risk of $1,101, which maybe it's too much, so then you will trade a different stock. But if you were okay with that risk, that gives you a fair chance of at least breaking even, thanks to the Chebyshev theorem. Now, take a look at what happens if instead of the 385, I use a deep in the money option. So if I use the, let's say, the 375, of course, my probability of breaking even or better is going to be even better because that option is deeper in the money. So it will take for the S&P to drop by additional $10 from 385 to 375. That's additional $10. And if that was to be the case, I would still be breaking even. So I'm giving myself a $10 greater chance of this to work. So of course, now notice the location of the Chebyshev line. So my break-even point is still inside, but now so much more to the left. Okay, now, of course, what's the issue of that? now I got a greater probability, but now I have to pay more, 17, right? $1,700 instead of 1,100. So what if now I use the 365 option? What if I go deeper in the money? What if I go deeper in the money? Now I need to pay $2,500, but now based on the Chebyshev theorem, now Mr. Chebyshev is saying is basically telling us we are overpaying for this because, you know, yeah, fair enough. You're gonna have even more probability of breaking even or better, but you know the risk you are taking doesn't add up to probabilities, and that's why now the crossover is outside the box. So we are now paying too much. In the other extreme, and I see a few questions. I'm coming to you in just a second, guys. In the other extreme, so if instead of 385, which was the initial peak, I was to look at, let's say, 395. So of course now the trade is going to be cheaper because the option is going to be out of the money. So now the option is going to be 590. But notice how we are still crossing inside the zone, the rectangle. But now instead of the shaded area, we are inside the light zone, which means that now, I mean, it's not a crazy choice, but certainly we are losing significant amount of probabilities by being there. Okay. And if you were to use, instead of the 395, you were to use an option which is located extremely far away. Okay, so for example, I'm gonna use, let's say, 435, just for fun. This is a crazy far away option. So now this option is gonna be very cheap, right? 15 cents. So guess what? The probability of break even is basically nothing. I mean, you bought a lottery ticket, you are extremely likely going to lose those 15 cents. Extremely likely. You are totally outside this zone by a lot. Is, you know, I would say based on probability and again the Chebyshev theorem. It's basically no way. It's a no way situation. Okay, again, no way. Just a simplification of my language here. Okay, so now. Same thing, and I know you have questions. I'm coming back to you guys. Just give me a moment because what I'm showing you here may actually answer some of the questions. So one sec. I'm back to where I was before. What if you change dates? So what if instead of August 19, you select the September 16 expiration I selected before, or let's go a bit further. What about December 16? Well, if I go for December 16 and I click OK, notice that I'm still okay. I'm still inside the zone. So the 385 call will still make sense. Okay. But now let's say you are doing a very long-term trade and maybe you are doing a leap. So you are doing December 15, 2023. So actually the 385 in this case is still okay. Interestingly enough, I thought that would not be the case in this particular case, but it is the case. Okay. Let me see if I can pick December 20, 2024 and see what happens. It's still the case. Okay, so I guess that strike happens to be ideal, which is the whole goal of this tool is to find the ideal strike, the ideal strike, and I guess in this case we found it. There will be cases where changing expiration date implies adjusting the strikes, and this is the purpose of this tool, to when you build your trades to adjust the strike the best you can. Of course, doing it manually is very tedious. Later, I will show you one way to do this automated. But I want to do it manually first so you see how it's done. So for example, let's say you wanted to use September 16, right? And the 385 is giving you an okay, right? So what I do, what I like to do is I like to be slightly in the cheap side because that reduces my risk, but I don't want to be cheap. I just want to be very cost efficient. So I like my selection to end up creating the break-even line as close to the end of the shaded area, maybe a little inside the lighter area. I'm okay, but I don't want it deep inside the light area, but as close to this particular edge as possible, right? So that way I keep some probabilities in my favor while I make the trade as cheap as possible. That's what I like to do. So how will you do that? Well, you just do it manually. Go to 388 and see what happens. We're still inside. So go to 392 and see what happens. still inside. Okay, go to 396 and see what happens. Still there. This is looking pretty good actually. Let me see if we go to a bit higher. Let's say 400. See what happens. 400 is already in the other zone. Okay, so that I will not be too happy. Again, sometimes you will deal with options strike price increments of $2.5 at a time, and then you cannot do anything else. But ideally, I'll be able to adjust this better. So 398, I would say that's good enough. It's slightly, very slightly inside the shaded area. I mean, if you do 397, it's fine too. This is $8.23. If you were to do the 397, it's gonna be maybe 800. Funnily enough, I said it backwards. Of course, it's a bit more. It's 868. And now it's slightly inside the side of the shaded area. So that would be the sweet spot. If they're a little bit on the left, a little bit on the right, it's fine. Again, I'm tolerant, I'm flexible with this because sometimes you have options change with $2.5 strike price increments, $5 strike price increments, and you just cannot be as precise as I did right now with the S&P with $1 strike price increments. But anyway, so now the 397 call is ideal because it's kind of like the cheapest one, where no matter if there is a bias, a skew in the market from a price distribution point of view or not, this trade stands by itself, forget about everything else, stands a fair chance to breaking even or better based on the Chebyshev theorem, okay, which is a good odd to put in your favor. Of course, we never advise you to trade just based on that. Of course, look at your UFOs, look at the market sectors, look at your auto climate, look at the Elliott waves, whatever is it that you do in your trading plan, just do that. But now when picking the call, that's how you can adjust it. And then if you want to build a spread, right? So then on top of the 397, now you can go ahead and, maybe you sell, I don't know, the 400 to 414, and that's your bull call spread, right? That's your bull call spread. But when you did that, and by the way, when you do bull call spread, notice how the call thing goes away. Okay, I mean, you could activate it or deactivate it. Okay, you could activate or deactivate, but by default, when you do a spread, it goes away because really this ideal strike zone selection only makes sense to be applied to the commanding unit, okay, which is the unit that either generates a debit when you do a debit trade, such as bull call, or the unit that generates a credit when you do a credit strategy, such as a bull put, for example, if you were to be bullish. So therefore, by default, it goes away, even though you could reactivate it if you want. But now you would have the peace of mind of knowing that you've just built a spread where one of the units, okay, it's also adding Mr. Chebyshev to the equation. And that certainly is another source of help. And any probability in our favor that we add, certainly it's welcome. Now, all of this process, as you can see, is tedious. Joe, I see your questions. I'm coming. I haven't forgotten. Just to make sure you've seen it, because I know some of you have seen it, but not everybody. So when building options trades with a spread select tool, which I will cover in a different session, so I activate filters where I have a template already set up for this. Okay, so for example, a bull call spread, preferred parameters. Anyway, you could activate or deactivate this without a template. Where notice here, you could force for the options that you buy, that you want the options that you buy to be in the fully shaded area or the lightly shaded area, or you want them to be outside. Okay, so you could force that. In my case, notice how my preference is I want probability in my favor for the options I buy when I do a bull call spread, because a bull call spread, the commanding unit is the one you buy. So that's why I want it to be full. So I got Mr. Chebyshev on my favor. And then for the short legs, I want the opposite. I want my short units to expire. This, by the way, Joe, for cover calls could also be a good prerequisite, okay? Because Mr. Chebyshev would be pointing at the options that are likely going to expire, and therefore you would not be called away. Right? Going back to the prior chat about cover calls. So anyway, when you do it here, so then of course building the trades is speed of the light. Again, I won't do it today because we don't have the time, and this is not the session. for this purpose, but I just wanted to mention it because obviously doing it here, it's a bit tedious. Okay. Now notice one last thing here before I look at Joe's questions. If I open a new symbol, for example, Apple, right? By default, the system is gonna add a long call for me. Well, sorry, let me rephrase that. If I close, this is what I meant. If you open a risk graph from 0, by default, it will come with a long call. And by default, the long call will be adjusted to be in the middle of the ideal strike zone. All of that is done for you automatically, right? So a good way to start building your spreads is either get into a call or get into a put if you want to be bullish or bearish. Automatically, this will be adjusted for you with the right strike. A strike that, to my taste, is very much in the middle of this zone, which is, I would say, the perfect spot. But again, because I like to be just a little more price efficient, I like to bring this a little bit closer to the lightly shaded area. Okay, again, this is just my personal preference. So then I would do this manual adjustment, as I mentioned before. But now the beauty is that you have your long call, you have your long put, and now the one thing to do is to just add more units to the strategy you're building to make it to be whatever you want it to be. Okay, so we got 2 things left before we conclude the session, which I need to talk about the sliders below, and I have a few questions from Joe. So the question about the ideal strike, I think I took care of that. Target date, I took care of that. Cover calls, I took care of that. Yes. So when selling a call, the box needs to be to the left of the break even. So yeah, so when selling a call, okay, so if you are bearish, short a call, okay, so if you don't want it, okay, to be here, okay, you need to make sure your P&L, okay, is going to be in a different location, okay, and therefore you need to act on moving the strikes accordingly. Okay, you can either do it. I think probably this is more confusing for most. So at least the way I think about it, I like to think about when I sell calls, I want them to be outside instead of inside. So maybe an easier way to think about it is always plot your long call and just make sure that when you sell a call, it's above this zone. Above this zone doesn't mean you need to sell the 162 call. Okay, the 162 call may not be above that zone, or maybe yes. We don't have 162. Let's say 165. Okay, the 165 is very far away. Okay, sometimes you may get the 162 and it's still inside. So again, the strike price does not necessarily coincide exactly with where the P&L on expiration will be. Remember, we are looking at the crossover between those 2 lines. That's what we're looking for. Okay, so you want that to be somewhere outside. But if you want to do a cover call and get paid decently, probably you'll need to be somewhere close here. If you're doing the 165, you may get paid too little, in this case 95 cents. Okay, good. Probably this answer all those questions. Okay, and now so the last thing which I'm going to cover very quick because we are reaching the end of the session is the fact that in the risk graph we have this dotted line, right, which this dotted line can be represents the real-time values and therefore varies as you change, for example, the date, or you change volatility values. So, for example, you can come in here and notice that we got multiple possibilities for indications. Notice only one is checkmarked. Why? Because I only have one expiration date. So if I was to simulate options trades with multiple expiration dates, I could use different types of lines for different dates and therefore understand the behavior of my trade thanks to different dotting styles. In this case, we only have one expiration date, so I'm just using one, and here's the date, right? So what can you do? You can use the slider to move it, and as you move it, you are changing dates, which you can see represented here on the left. Okay, if I go back, August 5 becomes August 2. If I go right, August 2 becomes August 9. And as I'm doing that, notice how the dotted line is approaching the solid line, which is the one which represents the values on expiration. On the right, instead of working with the dates, the sliders on the right are representing volatility. Okay, so what if the options inflate in value? So the current option that we're using, okay, has an implied volatility of 28.26. Um, that's the implied volatility built in the option. Okay, there is a series of adjustments that the platform will do, because when doing simulations, we simulate theoretical values. So notice that instead of 28.66, it does 28.21. Again, this has to do with looking for theoretical values and trying to soften some price distortions and things of that sort. So just go with it. But in any case, now you can move the slider right or left. And as you are moving the slider, sorry, I did it in the wrong one. I need to be doing it in the next line. Sorry for that. So as I am adjusting the slider, okay, notice how the graph varies. Okay, the graph varies, and you get the new P&L that would take place, at that moment in time. So now, if the stock was to move to 165, okay, so the amount of money the trader would make is $1,250. Okay, where if volatility was to drop and the stock moves to 165, so now the trader will not make 1,250. The trader will make $700. Why? Because volatility shrinked the value of the options. You can simulate and emulate all of that. You can also work on changing the interest rates, which that I would say, unless you're using very long-term expression, the options will have a lesser impact. You can see the line didn't move too much, but certainly you can change it if you are doing certain simulations. Again, very the raw values which impact that certainly are greater the longer the expiration date. So that's why I said, this is important if you do leaps. If not, it's less useful. Okay, and the very last thing to comment is about the compare spreads. But comparing spreads, it's a functionality within a functionality. So we will talk about that in the next section because there is lots to say about that. And we will cover that with no rush. Hopefully today was a good session, my friends. I took my time because while a risk graph is a very basic tool available in all trading platforms, again, the subtlenesses, the small details make a very, very big difference. And I love to take these top sessions easy from the point of view of adding details to you. And if I gave you a couple of aha moments during the session, even though you've seen risk graphs for years, then I'll be very, very happy. So anyway, my friends, hopefully the session went well for you. I will now say goodbye to everybody. And I will see you in the next one. Bye-bye, everyone. You guys take care.